Chip stocks just pulled Wall Street out of a rough patch, and easing tensions in the Middle East gave the rally an extra push. US stock indexes moved broadly higher in the latest session. The recovery was led by semiconductors, companies that design and manufacture the chips powering everything from smartphones to data centers. The sector had been under pressure for several weeks. A rebound there matters beyond just one corner of the market. When chip stocks fall, it often signals worry about slowing demand for technology and weaker corporate spending. When they climb back, it tends to reflect growing confidence that businesses and consumers are still spending. Traders read that as a green light for riskier assets more broadly. Layered on top of that, signs of reduced tension in the Middle East helped clear another cloud hanging over markets. Geopolitical flare-ups in that region have a direct line to oil prices. When conflict risk rises there, energy prices tend to spike, and that uncertainty ripples out to investors worldwide. When those fears ease, traders typically rotate back into growth-oriented assets like stocks. That appears to be part of what happened here. The Federal Reserve adds another layer to how investors are reading this moment. The Fed is still watching inflation closely before deciding its next move on interest rates. Any development that reduces uncertainty tends to be welcomed on Wall Street. Cooler geopolitical risk can ease pressure on energy prices, and lower energy costs can take some heat off inflation readings. That is a chain reaction the Fed watches carefully, and so do markets. Still, one session does not rewrite the outlook. Single-day moves, even broad ones, do not always signal a lasting change in direction. Markets can reverse quickly if fresh data or events shift the picture. The questions traders will be asking in the days ahead are straightforward. Are Fed officials sending new signals about the pace of rate changes? Is the incoming economic data, jobs, inflation, consumer spending, holding up? And are conditions in global flashpoints staying calm, or is new risk building? The durability of this rally depends on the answers. Improving sentiment is a start, but sentiment needs to be backed by steady data. A single session driven by a sector rebound and a geopolitical sigh of relief is encouraging. It is not, on its own, a confirmation that the rougher stretch is over. The practical read here is simple. Watch what the Fed says next, and watch the economic data that follows. If those line up with the calmer mood markets are pricing in right now, the rally has something real to stand on. If they do not, the rebound may prove short-lived. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.